Good afternoon. I'm Laura Ehrenberg-Chesler, co-CEO at Crossvault Capital Management. In part 4 of our ongoing series with Mark Flasser, who is a co-founder of Sandler O'Neill, an investment banking firm in New York, we will be discussing the difference between investing in bonds and riskier assets in the current economic environment.
The bond market has actually two pieces to it. It has a short piece, which the government controls. The Fed controls short interest rates. They mark them right now. They're zero. That's a pretty high number, zero.
And Mark, how do you define short interest
Short,
rates?
I'm saying overnight lending. Overnight lending
okay.
is zero. Okay. So if you go to a bank and ask them how much we're going to pay for my money, because they say, well, I got lots of money, and the government gives it to me at zero, so why should I pay you anything for it? So what is your likely return you're going to get? It's going to be very low. So people are flooding money into the banks today for very low returns, because the alternative is to put it in some risk asset for which their expectation is they're going to lose it all.
Right. So
better to have a low return and at least know where it is, or no return and know where it is, than to put it someplace where you may get less of it back.
So that's what's happening on the short side.
That's what's happening on the short side. Then on the long side, you have this inflationary expectation, which is at any point it's always out there. Whether it's right or wrong, it's always out there. And that will drive yields higher. Because the more money that's on the ground, the more somebody's going to believe it's going to cause something to happen. It may not, but that'll be built into the pricing model. Now, one of the problems we deal with right now is that the same government that we're talking about, besides the politics of it all, has stepped in and said, we don't want interest rates to go up on the long end either. And so we're going to step in and we're going to influence the price of longer bonds.
And they do that by buying
they've done that
treasuries, buying in mortgage-backed securities.
They've done that, $1 trillion to mortgage-backed securities, commitments between now and the end of September, and $300 billion of treasuries. And while we sit here today, other forces are going on, okay, which were in today's paper, where what we call the BRIC countries, which is another group that's trying to show their muscle in the world economy. BRIC stands for Brazil, Russia, India, and China. And those four countries yesterday said, we think there's enough dollars in the world market, and we're not sure the dollar is the right reserve currency. And so we're going to buy something else. And in the last couple of days, that's been talked about. And yesterday they said, something else is going to be IMF bonds. The IMF never issued bonds before, and they now have a source that wants to give them money. So they're going to issue bonds, and Treasury bond prices went down, and we've raised the interest rates on the long end of the Treasury market 100 basis points in 30 days, which is quite a move.
That is a big move for people who are unfamiliar. 100 basis points or a full percent is a big move in the bond market.
Which immediately has the effect, if we go back here and talk to individuals, is that the 30-year mortgage commitment rate also jumped 100 basis points.
Right, and then that pressures housing.
And that
means the opposite effect of what we're trying to have.
That's right. So the other forces are going on. We don't control our economy. We have a world economy. We have a world influence on our economy. And I don't believe the people that manage our country understand that. And what they learn, I don't know. But markets do not at any time understand everything that's happening at one point in time, and that's why every day you see stock markets go up and down, and your analysis on those stock markets sounds like they're terminal. More buyers than sellers. People were worried about inflation. Oil prices went up. None of those could be the one thing that happened that day that wasn't going to happen the next day.
Right.
So it can't be a terminal event.
Right.